much for joining me on Trading Day. I'm Amber Kanwar. So we've got a couple of trades that we're going to analyze. But first is the broad market. The S&P 500, a fresh all-time high, which you could view as a bullish indicator. Or if you've been a shareholder or an investor in the last couple of years, it's really just returning to where we were about 2 years ago. Let's bring in Dan Rohinton, manager at IA Global Asset Management. There's certainly something psychological about hitting fresh all-time highs.
That's right. And it's been 2 long years where there's been a lot of rotation, right? So the fact that technology is leading the market higher and breaking out to all-time highs is very reminiscent of how we reached all-time highs in the last place. So you see the valley that tech stocks went through in 2022 and 2023. So we're back being led by some of the most profitable, successful companies out in the world. So it's not a surprise that the economic data might be a little bit more muddied, but the best companies in the world are leading that trend. And that's where the S&P 500 mixes positively.
And people like to complain about that, right? And you do note that once again, the larger proportion of the S&P 500 is not hitting those new highs, hasn't participated in the rally. But should we just take comfort? Gains are gains if you're an index investor.
You know what? Most years are like this, actually. So most years, the breadth of the market isn't uniformly spread out where all 500 companies are doing it in a kumbaya fashion together. There's always leaders. Sometimes it's industrial, sometimes it's more value stocks. And more often than not, in the recent paradigm that we've had, it's technology stocks. So I'm not surprised, and I'm happy that investors are making money in this process.
And are you continuing to hold on to those tech stocks?
We're getting more selective. So when you're looking at companies like cloud computing, that is a 10-year plus trend, and they're also interfacing closely with some of the AI companies and the semi stocks as well. So you have to be a bit more selective because software does come and go. But if you start with the hyperscalers, also known as the cloud computing companies, you really can't go wrong.
So give me some names in that basket.
So you got to start out with Microsoft because it's a full stack player. So they have infrastructure as a service, platform as a service, and software as a service. You get it all with Microsoft. But then you can go to Amazon Web Services and Google Cloud. But those are really second. Google Cloud is specifically a number 3 player in what is really a 2-horse race.
Let's look at some down and dirty opportunities, though. It's all fun when you've got these all-time highs, but sometimes you have to buy when there's pain in the market. I mentioned earlier that Archer Daniel Midland, there's a lot of pain there today in the shares. Accounting issues, perhaps around their nutrition business. The CFO is on leave. But is it a buying opportunity?
That's a little too much pain, Amber.
Okay.
So let me explain maybe just the history behind Archer Daniels and the nutrition division and why it's so important for its valuation. The first is that they're a quintessential trading and upgrading company. So they'll take raw soybeans and then they'll crush it, upgrade it. And the hope with the nutrition division was they could go even further up the value chain. So when you find accounting irregularities in your most profitable, fastest growing division, due to transfer pricing, that raises a few more questions. And everyone knew that the soybean crush margins were actually going to come under pressure, cyclical pressure. So
we were already worried. Nutrition had already not kind of lived up to its hype.
That's right. And we were already worried about the cyclical margins that the soybean business had. So put the two together with an accounting investigation, you can see why investors are taking a rightful, well-deserved long pause on this stock.
What would it take for you to take a position in the stock?
Clean accounting. You always have to have clean accounting, and trading companies specifically, of which Archer Daniels is one of the biggest in the agricultural side, they tend to be the most exposed to accounting issues. So you need a clean bill of health on accounting, and from there we can talk about the cyclical position and the valuation. So I can't tell you that there's the right price for it today because we don't know how uniquely reconciled the books need to be.
Right, and I guess the issue is when you hear the word accounting irregularity or problems, where does your mind go?
Everyone's mind always goes to Enron and WorldCom. Usually it's not so egregious. Accounting's really come a long way, but this is a $100 billion revenue company with transfer pricing internally as the question mark. So it's really tough to say what the right number is for this stock. But when it comes to accounting, let's get the auditors to give a clean bill of health, and then we can talk about the opportunity.
Let's talk about the opportunity, if any, in the Canadian market. It struggles. We're about 6% away from an all-time high, but there are definitely outliers, and one of them I reference is Fairfax Financial, a fresh all-time high. It's up 60% over the past year, trounced the TSX. What is the momentum underneath this name?
It's actually reasonably valued, which is a little absurd to say given how much it's outperformed. It's because Fairfax was years and years of untapped potential. So first and foremost, the investment portfolio is not run as a proprietary hedge fund. It's run as a more conventional investment portfolio. That, along with interest rates going up, has led to a big boom in their profitability. And then add on the stability and the discipline that Prem Watsa had instilled in Fairfax on the insurance side, and you really have both sides of this behemoth in the Canadian market finally firing at full cylinder.
What's the risk, though?
Interest rates come down and they can't redeploy their investment portfolio. So when you look at the clean numbers, it's 10, 11, 12 times earnings, which is a very fair price for a global diversified insurer. And the other risk, if I may take a little bit more time, is actually that we've had a multi-year hard market in commercial lines. And with inflation coming down, that tends to mean claims inflation falls, which means premiums slow down in their growth. Is that a big risk for a company at this valuation? I don't think so, but it is something to watch.
Do you get a sense that they're positioned for that environment of interest rate cuts? I mean, that's what the market is looking for.
They aren't positioned yet, but I think give it a few more quarters for higher for longer, and they could really be in a good place.
And is that a play for higher for longer? Do you think Fairfax is a good play? Because everybody, I'll look at Carvana today, which I think is that's a whole other kind of play. That's more of an animal spirits rate cut party. If you're thinking, if you want to hedge your bets, that maybe rate cuts don't come as swiftly as we think, Fairfax the place to be?
Fairfax in Canada is unique real estate because it's defense and a little bit of offense. It's defense because P&C, property and casualty commercial insurance, is naturally a defensive business. So you don't have the credit risk that the banks and the life cos do. And you have the interest rate optionality as they recycle their bond portfolio into longer durations. So it's almost the best of both worlds. It's trading at a more fair price than it used to, but you can see why
investors... You wouldn't hesitate, though, to add?
I wouldn't hesitate to add.
All right.